We rely on it for practically everything: fueling our cars, building commercial planes, manufacturing plastics, and generating electricity. The modern global economy runs on millions of barrels of oil moving across the ocean every single day. But because oil is so vital to a functioning society, it creates a massive geopolitical blind spot. Right now, nations that consider the United States a direct adversary are sitting on stockpiles of billions of US dollars. They don't do this out of goodwill. If a country wants to keep its factories running and its citizens warm, it has to buy oil. And to purchase that oil on the global market, they are forced to pay using American currency. This link between energy and American currency forms the petrodollar, a deeply engineered mechanism of global financial control. This system provides the structural foundation for most modern international conflicts and the current distribution of global power. The structure of this system started in the ashes of the Second World War. While major industrial centers across Europe and Asia lay in ruins, the United States emerged with its manufacturing base entirely intact. That economic disparity allowed the U.S. to set the rules for the post-war recovery. In 1944, at the Bretton Woods Conference, Allied nations agreed to anchor the global financial system to the U.S. dollar, which was initially backed by physical gold. That gold standard eventually broke down. In 1971, President Richard Nixon abruptly severed the dollar's tie to gold in a move known as the Nixon shock. This transitioned the world to a fiat economy, where money derives its value from public trust and state stability rather than a physical commodity. That trust was immediately tested. During the 1973 OPEC crisis, Arab producers restricted oil sales to nations supporting Israel. They weaponized their supply, quadrupling prices practically overnight and triggering severe fuel shortages and high inflation across Western economies. To stabilize the situation, the United States struck a critical deal with Saudi Arabia. America would provide the Saudi kingdom with military protection and support, and in return, Saudi Arabia agreed to exclusively price and sell its oil in US dollars. Because Saudi Arabia dominated the global oil supply, other major producers quickly adopted the same standard. Suddenly, any nation wanting to purchase crude oil had to acquire American currency first. This created a permanent global demand for U.S. money. It allows the American government to borrow at lower interest rates, maintains the purchasing power of its citizens, and gives Washington the ability to financially pressure foreign adversaries by locking them out of the dollar network. We usually think of the oil industry as massive physical infrastructure, pipelines, refineries, and storage tanks stretching across the desert. But the financial infrastructure supporting it is equally immense. This illustrates petrodollar recycling. Oil-producing nations don't hold their massive American cash reserves in vaults. They actively reinvest into U.S. bonds, corporations, and real estate. This continuous loop flows back into the U.S. financial system, reinforcing the dominance of the American economy. Walking away from this loop means abandoning a highly liquid market where you can move billions in seconds. It requires dropping established insurance networks and the predictable legal protections that come with using American banks. Switching currencies is not a simple administrative change. Moving away from the petrodollar requires dismantling the world's financial plumbing and building entirely new pipes from scratch. That immense difficulty is why rival nations are now pooling their resources. The BRICS trade alliance has become the primary geopolitical forum for countries looking to dismantle the U.S. financial monopoly. The motivation is self-preservation. By heavily wielding financial sanctions to punish foreign actors, the United States has signaled to these nations that relying on the dollar is a national security risk. Take a look at this structural workaround. Russia shifted its massive oil trade with China into a parallel system, settling transactions directly in yuan and rubles. Simultaneously, Moscow liquidated its U.S. Treasury bonds, ensuring American regulators have fewer assets to freeze. Beijing is promoting this momentum by encouraging yuan-denominated oil contracts across its network of trading partners, integrating its currency into the global energy market. Rather than seeking reforms within the existing banking system, these nations are engineering a parallel architecture to operate outside of it. With capital beginning to move into these alternative networks, there are questions about the long-term future of the American dollar. Despite the sensational headlines, the US dollar is not at risk of a sudden total collapse. What we are witnessing is a calculated, selective shift. Nations bypass the dollar when it is politically necessary to avoid sanctions, but they continue using it when it offers speed and efficiency. It operates a lot like a tech monopoly. When the entire planet is already integrated into one platform, migrating users to a brand new system is a slow and difficult process. The petrodollar system is losing its exclusivity. As more nations successfully trade oil without the dollar, the United States faces a world where its primary financial lever is no longer a universal influence.